Now we turn to China, Asia in general. So we're just going to talk about China at first, and then we're going to talk a bit about Japan and India at the end. But we really want to touch on some of the things here where when you look at CPI, expectation was for 0.3, came in at 0.1. PPI was expected at negative 3.3, came in at negative 3.6. So again, you're seeing some of that movement lower, which there was an expectation of some of those increases because year on year comps were a bit easier. But again, you see some of these pressure points. Aggregate financing came in well below estimates, as we've talked about. We talked about it last week. We're not going to rehash it yet. We want to look at the charts, but just kind of put in perspective, there's not any real stimulus happening. If anything, there's actually contraction of money supply. When you look at lending facilities, they came in. When you look at term lending, expecting right in line with kind of expectations. Industrial production. Now, this is the important piece, which we're going to talk about in more detail. Industrial production expected to be up 10.9%, came in up 5.6%. Year to date was expected to be up 4.9, came in up 3.6. Retail sales, which had a massively, and now mind you, all of these had super easy comps. That's why the numbers were so high on the estimate side. Retail sales expected at 21.9, came in at 18.4. Year to date, was expected at 8.2, came in at 8.5, but fixed assets was expected at 5.7%, came in at 4.7. Property investment expected at negative 5.7, came in at negative 6.2. Again, none of these things are good for growth. None of them are saying the GDP is booming. It continues to see a big issue in general. So when you look at the new home prices month on month, came in at 0.32, so small increases there. With a foreign domestic investment, came in at 2.2%, well below their expectations. So retail sales, when you look, fixed asset investment, again, down. Value add output at industrial firms rose 5.6%, but while the growth rates look impressive, they are flattered by the economic disruption from COVID lockdowns the same time last year. That's the whole point. April's data missed expectations across the board and continues to fall short of expectations. China's economy continues to be stuck in a two-tier recovery. Consumption is recovering okay. The rest of the economy continues to contract. Month-on-month increase in retail sales adjusted for seasonal distortions was 0.5% in April. FAI fell 0.6%. Industrial value add decreased 0.5%. Consumption-led growth in China is what economists have been calling for. But if this doesn't boost business activity and jobs, it'll soon fizzle, which is really kind of our base case. For this reason, falling private investment and high graduate unemployment concern. Private FAI dropped 0.2% last month, despite falling 0.9% year on year. Graduate unemployment last month hit a record of 20.4%. Officials have, they've held back on stimulus, but this is, again, the big policy moves as they assess the shape of the post-recovery. The question is, are we going to get more intervention? My problem is the law of diminishing returns. They've been using stimulus so aggressively that you just, no matter what, you just can't get to that next level, especially when we start looking at some of these charts. So China retail sales value came in, again, well below estimates. And typically we have the drop. The question is the steepness of the drop and what is that recovery going to look like, which is why we see some of this negative move. And that's where things are going to flatline a bit. And we think that it's going to get a bit worse in comparison to previous years. So when you look at the dire signal from credit activity, equity prices in the euro area continue to move lower. Firm credit demand continues to move down. Equity prices continue to come under pressure. Bank lending standards. When you're looking at the euro area in general, and the reason why we talked about this in the last segment, we're talking about it now, is because when you look at Germany, when you look at the EU, they've become a much bigger part of what's happening in China. So if you look at a huge movement down in firm credit demand and the bank lending and when you look at the money supply, all of these things, we've talked about it in the US, we've now talking about it in Europe, continues to show that it's going to be really difficult for China to continue to grow and hit these levels if things are slowing now, foreign direct investment, imports, exports. but yet globally, things are going to get worse. So how is it possible, unless you get a massive consumption boost, which if you look at it, they're super easy comps, and China still wasn't able to achieve it, which is why we think that there's a gross overestimate in what China can do over the coming months. When you look at shadow banking, it's coming back at more aggressive pace, and China is determined to increase the international competitiveness in manufacturing and industrial sectors, but with what money? And that's when, if you look at how China, the CCP, the PBOC has aggressively gone after shadow banking, but now it's coming more back into fashion. And it's because they can't get loans and they have to find other ways to move things forward. And that's when you start looking at some of the pressure points but remember, Xi wants to increase competitiveness. He wants to increase manufacturing. He wants to increase industrial sectors, but using SOEs. So if you're a private company and all the good stuff is going to the state-owned guys, well, how are you getting financing? How are you trying to do this? And shadow banking is coming back into favor, especially as monthly new loans are well below where they used to be. When you look at China aggregate financing, well below where they have been historically. And again, there's always a drop, but look at the steepness of the decline. And that's where I continue to see problems. And that's, again, why the PBOC, because you might be thinking, well, things are going to change because the economy is going much weaker. It's like, but look at how every year there's been more and more and more loans and financing. It means that the next level of growth, in order to hit that law and cover the law of diminishing returns, it has to be massive. But there's already so much liquidity in the system. There's already so much debt in the system that it would just overwhelm. So again, they're kind of stuck with the ability where they might give some sort of benefit or levels, but because there's so much liquidity, there's so much stimulus already in there, law of diminishing returns means that the next dollar is not going to go as far. And then we're going to hit a point, which is where I think we are now, that it's not going to go any further, and we're actually going to see some fairly large declines in terms of activity. Monthly new loans cumulative, when you look at financing cumulative. So again, everyone's calling for more stimulus, but it's like, guys, there is more stimulus. Like, what more do you want? And that's where we continue to pressure and highlight that every year, starting from this point, going back through 2015, every year is more and more and more and more. So law of diminishing returns, it takes an exponential amount of more to get the same benefit until every new util has a negative impact. And that's where we sit at the moment. So 7 Chinese provincial regions saw CPI growth turn negative, showed local government data. Shanghai fell 1.1%, the fastest among China's 31 provincial regions. Again, none of this is showing growth. So you have all of this new loans and cumulative financing, and you have CPI falling. Again, like, what more can they do? Which is why we continue to say that China is stuck in a rut. And we're not going anywhere here. Manufacturing and emerging industry PMIs continue to roll over. Industry capacity utilization rate continues to go below the long run average. And again, all of this is showing the contraction that this is, and that's when we look at what is happening in China, what is happening abroad. None of this is showing that there's going to be this huge surge of activity that's going to support some of these views of a big Chinese boom. And again, we're not saying that China is going to fall the GDP is going to fall 10%. We're just saying that the expectations in the market are grossly overstated, and it's going to come much lower as some of these things move through the system. Now, Xi still has those huge ambitions for the industrial economy. So they want the modern industrial system, but the main focus is Xi is in town for the China Central Asia Summit and the modern industrial system. What is it? Xi's vision for China's industrial development and economic transformation. The vision encompasses a shift from China's traditional economic structure to one based on advanced manufacturing, high tech. But again, we've been hearing about this forever, but the issue is, how are they paying for it? And who's going to drive it? Because they've talked about how they want the SOEs to drive it, but if the SOEs are driving, well, the private guys aren't going to do much. And again, the way that they were trying to bring people back home was protecting IP, supporting private industries. Well, are you going to go back if you have a degree in advanced robotics, advanced AI, and you can't create something of your own? Are you going to stay in the US or are you going to go back? And again, that's where we see these pressure points continuing. China property starts by floor area on track to be 60% below the 2021 peaks, which is equivalent to 18% of China's consumed steel. China is going X growth rate by, so again, like it's just not a lot of good things happening. When you look at industrial production, expected at 10.9, came in at 5.6. But again, even that increase was driven by state-owned, not private. Private is still shrinking. State-owned is increasing. And again, this is not something that's going to drive long-term growth, or at least growth that is going to be private-driven, and why we think enterprises, and especially foreign companies, are not looking to reinvest and they're looking to move. Xi wants China to become more self-sufficient in food and energy, and that's not crazy when you think of grain security as a matter of national importance. Seeds are the chips of agriculture, and again, they continue to push the importance of food because, as we've been saying time and time again, food issues are real. Now, when we look at China property investment is running well below the 22 and 21 levels, and it's not going to get any better. And as that investment slows, again, another big piece of GDP, another fall in general, and net percent of expecting stronger Chinese economy. For those that have been following us, we are not jumping on a bandwagon. We thought that people were grossly overstating their expectations, and now they're starting to come closer to us. Commodity prices in China are moving lower. And again, because there's not the demand. And that's why when we look at the data, when we look at all of these things, there's a big movement lower, especially in the chemical side, which is why we see chemicals coming down as well and seeing pressure. Official China April retail sales saw the jump, but not enough to overcome the view it was due overwhelming to base effect. This makes May the most highly anticipated data. So again, May is going to be an important month, but there should be something to say in general. Rising Chinese consumer borrowing. So the question is, are people borrowing a bit more, moving some of this product? But then when you look at China's FDI or foreign direct investment, you're well below 21, you're well below 22, and moving in the wrong direction, which we think is going to move to the lows again. So yeah, so the consumer's getting better, as it should, given the massive lockdowns and people starting to get back into some normalcy. We just don't see a lot of quote unquote revenge spending. And as other areas continue to falter, as inflation is showing more cracks, we see that borrowing slowing again. Japanese PPI was expected to be at 5.6%, came in at 5.8. So it's still falling, but not to the degree that the country wants. India industrial production was expected to be at 3.2%, came in at 1.1%. So we typically kind of get the spike, but you can see that things are starting to fade. And we're not saying that India is going to collapse, but again, we do see a bigger shortfall and a bigger slowdown. It's still going to be expanding, but just expanding at a slower rate, which I don't think people are expecting. Imports took a big step down, which again is a leading indicator for local consumption, for a local, exports. And then the India wholesale price index, which is a positive, came in at negative 0.92 versus the estimate of negative 0.4. So again, some of that inflation is slowing, but it's coming at an expense where the economy is slowing down as well. People aren't spending as much, and that continues to be a bit of an overhang. And then kind of wrapping up Japan, Japanese industrial production, it's still on a slow end, not as bad as it was, but the electronics parts and devices took another step down. So some of their key high growth, high value margin pieces continue to slow. And that's something that we see, again, the bigger picture of those bigger slowdowns in China. And Asia as well. So that's what we have for you today. If you have any questions, please feel free to reach out, and we hope you enjoy the rest of your day. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.